It is March 19th. Welcome to Wall Street Beats. I'm Benjamin Bry with Kevin Bakes Baker. We are coming at you with quite an interesting morning. How are you doing this morning, Kevin?
I'm fabulous. You?
Busy. So let's get it going. One of the worst days in 20 years in gold. When you want to pull up the gold chart, GLD, our technical.
Do I have to? Yeah.
What's that tell you, Mr. Chartmaster?
People want to get out yesterday, no, I mean, it's just, it is what it is. You can't argue with it. We're closing this gap back here in January. And, it's so funny because the conventional, thought is, oh, well, war's going on and people are fleeing to precious metals. Well, they did that over from August until January. And now the trade is taking our water. Just no other way to say it.
Yeah, I mean, my view is, as we talked about in January, is that I think we saw the high when we saw that blow off in silver, we saw a blow off in gold, and then we got a little retest, like bullish action. Now it clearly failed on the retest. And I think we look around the markets right now and interest rates rising all over the place, especially on the front of the curve, as basically the market comes to grips with the fact that Jay Powell's not leaving, and because this guy from North Carolina, Phyllis, is going to hold up the Warsh nomination, and I think the market just violently repriced that. And if he stays in, and he's clearly not a huge Trump fan, they keep rates here, and it's going to be easy cover because the CPI is going to rise. And I think gold is something that doesn't do well in a very tight deleveraging environment, even though, because if you think about 2008, right, gold did well into it, but then there was a deleveraging moment, and then it resumed doing well after that as well. And it just, when you see that chart, it's kind of hard. I mean, what moving average line is that red one? I mean, this is the weekly or the monthly? Yeah. So actually, let's put the monthly back up. Let's put that monthly is.
Yeah, well, the month, yeah, this and that's why I look at all the time frames. It's really hard to see, but it's still above the 200. It's going down below the 50. The 50, I think we're going to learn a lot in the next couple of days because, obviously the monthly volume has been really impressive until March. And I'm a little bit intrigued here on the daily that gold is trading at the high of the day. Now that's a little solace for longs, but we'll see how we end the day and the week. But right now, this is the bull thesis is really being questioned, to put it mildly.
I think that's right. And I think gold is something that got very, very popular. And I think anybody who's listening to the show, I've been an adamant gold bull for many years. And so I think that right now you have a crowded trade, and the it was just a blow off top, speculative stuff. It's going to keep going. Well, now you're kind of questioning that, right? You got the move back higher, and now we're kind of coming back in. So let's go S&P next.
Well, just one quick point. I mean, and this is why, I sell half when I have doubles, and I'm still making money in silver. And I sold a little more than half at, near the peak, not exactly the peak, just because I saw 100% gain in my account. And I said, sell half. And I didn't think about it. I didn't call an accountant. I didn't call an analyst. I just sold it. Now, obviously, I wish I had sold it all, and I'm reassessing what to do. But taking half off the table makes it psychologically easier to deal with this because it's all profit that I'm contending with now. So I recommend, if you don't have a sell discipline, I recommend getting one.
Indeed. I mean, you can actually pull up silver real quick too. Put up the SLV. Let's see that, just since we're talking about precious metals.
It looks similar but worse. It looks more exaggerated and worse now. The only thing I can say for it is that we're holding at this 60 level, and 50, was the 40-year breakout point, 46-year breakout point. And, by the way, that's kind of where the 200 is, give or take. and I don't want to see it much below this 50 level. And that's 13 points away. It's obviously down from what, 109? Yeah, 109 at the peak. So let's see if it holds this 60. It too is trading at the high of the day. You still have this gap down. Let's see if and how it closes this gap here from yesterday, and we'll see what happens. But we're clearly in trouble. There's no question about it.
Yeah, and I would agree. And now let's move the S&P real quick.
No, I got the SPY. That's what I use, and
that's what I mean. It's fine.
Yeah, it's 1/10 of the S&P.
Oh, there he is.
Yeah,
David, welcome.
Welcome. Sorry about my technical problems.
Oh, David, good to see you.
We're happy to have you here. So, what do you think there, Bakes? How's that look to you?
With the shows I've been doing with Steve Lamar, our other partner, we've been talking about these levels, and now we're taking them out. And we took out this 675 level. We took out this low here, this recent low, the war low, if you will. And now we're taking out the 200-day at 660. And so the next level is 650.85 down here. We'll see how it closes. But given some of the things we've been talking about with the other components, I mentioned 3 components of the Dow, Disney, IBM, and I'm forgetting the other one now, that look god awful. Obviously, big components of the S&P. So they're taking the generals out now, and it's getting bearish. Period.
Yeah. I would agree. David, we're just talking about how gold was having one of its worst days in 20 years. And then, and now we're looking at the S&P, which that is not a chart that looks very good. That looks like it's ready to do the elevator move down.
Well, I mean, we've talked about this before, that there's capitulations and then there's downturns, and we haven't yet had. It feels like a capitulation, right? It feels like if you're long the market, it feels bad. But a capitulation is where you wash out everybody and you say, okay, all the bad news is in. It seems like we're not yet there. We're not yet there.
Totally agree. And you know what? The situation that I've been talking about is like, look, equity volatility, the VIX is at like 25. It's, so it's elevated. But, if you think back last year, Liberation Day, you got up to like a 60, 70 vol. And when you have that, then you get a synthetic bid because guys can short puts and lock in like a 30% yield to buy the S&P down 20%. Well, that's a good way to go. Well, what could happen here is if you stay in this like 25 to 30 VIX level, you don't get that. And you get exactly what Dave was talking about, which would be something like 22, where, you're elevated vol, but no one can buy puts in order to hedge their book, which is a very popular thing to do. So like right now, the end of this week is option expiration. So there's a lot of guys who have been hedged, and thus the S&P is relatively held in, but you're now losing money both in your assets and your puts aren't protecting you. That's actually the worst case scenario, where we bleed lower. We don't actually get a capitulation. It just, hey, we're down 50 bips, and then you're down 1%, and like kind of what we've seen. And there will be probably at some point a washout, and you look for that. But like right now, that's kind of what I'm seeing in the market is this like slow bleed, and then bombs going off. Sorry, bad choice of words with the war going on, but gold is the latest example, interest rates, etc.
And here's the one thing that I don't want to get too bearish, and I don't want our members to get too bearish. But if a headline comes out, we've cleared the Strait of Hormuz, then these things are going to rip, and so you have to be wary of that and not get too over your skis on the bearish side.
Well, I don't know. I'll take the other side of that. I think that right now what the market's reflecting is it's in our power to stop this entire thing, right? So you would think that overall there should be some encouragement, but that there should be a bottom here, right? Because we know that at any point we could just say, you know what, we've dismantled it, or we've slowed them down, and whatever excuse we want to use, we can stop. But I think the market's reflecting that this is possibly expanding, and that the idea that the Iranians are being belligerent on hey, we're going to keep doing this. We're going to that it could expand even further. So I don't know if just clearing the Straits of Hormuz would get everybody to be. First of all, would we really believe it? Like, what's the proof that we'll have that, right? Because a couple ships get through, or because I think the only way is if Iran said, well, yeah, we're going to do that, which is not in their best interest to do. So I don't think it's a tough thing to prove. And unless we have a large coalition agreeing to do it, I don't think the market's going to believe that there won't still be attacks. What do you think, guys?
I mean, my opinion is I'm pretty bearish, and you have all the things that drive markets are going the wrong way on you. So you have credit spreads rising, high yield spreads are up 80 basis points in year to date. You have volatility elevated, but not elevated enough that you create the bid. You have the dollar rising, so the dollar wrecking ball work against you, and then you have oil, which is the primary energy commodity of the world, rising at an incredible clip. That squeezes people. And then yesterday, you basically had the market realize Jay Powell might not go anywhere, and you could have interest rates staying where they are. And look, so everyone knows, I'm long the SFRZ7s, which is December 27 SOFRs. Well, I've gotten my ass handed to me in the last 2 weeks as we've taken 2.5 cuts out. So now you have interest rates going wrong. All 5 things that are the most important things are going the wrong way on you. I think that's a lot for the S&P shoulders to handle. So
I wouldn't underestimate the Jerome Powell thing to the markets, because what it shows is that it's just like whenever they bring up the idea that the president won't step down at the time of a new election, even though it sounds crazy, the idea of an orderly transition of anything, let alone the Fed chair, that gives people like that idea of like, we're orderly, we follow rules, and the rest. So this sounds like, if you didn't think he was political, you now know, okay, this is political. Maybe he has legal advice, but it's clearly not hey, let's have orderly transition. Now, I'm going to say, I want to hear what you guys think of this. If I had $100,000 and I'm kind of newish to the market, would I be investing today, or would I try to wait for things to play out? My personal view would be, no, this is a great time to average in maybe a fifth of it, maybe not all in, because it doesn't feel like to me that this is the worst of the worst. But overall, the U.S. is in great shape. It's not great shape. It's in very good shape. Employment is high. Production is high. Things seem to be going okay. This is, I would say, a good time, if I were starting to invest, to put in some money. What do you think?
You want me to go?
Either one. There's only three of us, so.
To be perhaps redundant, what I do is I go through every ETF out there and I find the 10 best. And after going through that last month, I would be, in this example, I mean, I'm 23% in cash, because I took some money off the top of platinum, copper, and silver, and I'm really glad I did. The only thing I want to do today is short the financials. SEF is the ETF I'm looking at. I'm this close to pulling the trigger. My main problem in the past, this basically shorts the XLF financial sector in the S&P. Berkshire is 12, 13, 14% of that index, depending on the day, which is like, shorting mom and apple pie. But Berkshire's rolling over, and the Warren Buffett halo is gone. And so in your example, I would be 90% in cash and 10% short the SEF, and then waiting for new opportunities, and be cognizant of the fact that you could have some news that, we've won and oil goes down $15.
All right.
And stocks rip. I think it's very possible.
Ben, what do you think?
Yeah, I just think there's been way too much infrastructure damage. I don't think that you're going to get it to come back like that. And you can look, you're looking at WTI, but the spread between Brent and WTI is absolutely blown out. So the S&P is reflecting the reality that the U.S. is the relative winner here. Russia, Brazil, and the U.S. are the only people really built to handle this situation. Japan and Europe are absolutely getting hammered. Anybody who's energy dependent in forget about just oil. You're really talking about the refined products, like, and that is where you're really going to see jet fuel and fertilizers, urea. Like, and one thing that people aren't talking about enough is helium, which comes from the Middle East. There's a chance this can persist, and they'll actually have to shut down the Taiwan semiconductor situation. And that is like, then I'm short the SMH. Like, I'll tell you, that would be an absolute disaster. Plus, you have the whole like unknown, I'm sorry, of what if China makes a move on Taiwan? Like, there's just a lot going on here where I just wouldn't be cavalier at that S&P that's 26, 27 times trailing earnings. It's not like this is a deal. You know what I mean? Like, this isn't like exciting in any way, shape, or form as like, if it was 10 times earnings, okay, we could talk about that. But we're talking about 27 times trailing earnings with maybe a CapEx boom that is going to sputter out and a labor market that's weak and the revisions keep going down and everything I said before. Like, yeah, I would fade that pop. And I go with David that you don't really know what that actually looks like. A war. See, the difference between now and Liberation Day is that was completely in Trump's control. So the taco is all on him. This is takes two to tango. And to David's point about Iran, it's not in their interest, right? They didn't start the war. We did, and but that doesn't mean they have to end it because we're like, okay, we don't want any more pain here. And so, I think it's a dynamic situation, and it's just not like it's a good time to be in cash as much as you can know, and then just wait till you see some sort of capitulation and be ready to find what you want to buy. Like there'll be a point where you're like, hey, this is offered, but it's just not there in any way, shape, or form, in my opinion.
And so when you think of the things that you want to buy, it's interesting because I looked back, I was really happy with myself, as I usually am, about how I outperformed by about 5 percentage points the market each of the last 5 years or so, maybe even a little bit more. But I looked back, and two of the biggest contributors were really high quality companies that I bought that when the market was down a lot. So when you think about your shopping list and you think of things like a Disney or not kind of high quality names that are going to be around for the next 100 years, and you say, okay, well, and Kevin, you can shake your hand. It's bouncing off that 100. It's gonna, next thing you know, it's gonna be 105, 110. It's gonna be, but I say Disney as one of them. But quality names, the one that I had was Microsoft. Quality name. I didn't know that it would be a leader in AI or among them and have this whole move. So you're buying the quality leaders, not knowing what the world's going to look like 5 years from now. And so make that list, I guess. I don't know if you guys remember, there was a company, Next Decade, NEXT, that I had brought up on the show a couple months ago that a friend of mine had, who's on the board, bought $1 million worth of stock. And he doesn't, he has a lot of money, but he doesn't, throw around $1 million here or there. And I bought some based on that. I was like, he's smart. I know nothing about really, they're building out a huge natural gas production site. And it's going to take years and billions, probably $10 billion or more to build this. Won't come online for another few years. The second I bought it, it went down 20%. It was all as though someone was waiting for that to happen, and then continued down a little bit more. So now it's up a lot because of this news. I'm interested in hearing what you think about the chart, but I'll tell you my view is it was one of these positions where I said, you know what, I don't have exposure to this area. This is a long-term play. I'm going to be here. Did I win a coin flip, Kevin, or should I stick around?
It's clearly turned around, and my tiebreaker is always volume. This is attracting buying interest, and it took out the 647 level here. It's not it's not a pretty chart at this stage of the game, but it's clearly improving. And to Ben's point, what's going to bring nat gas prices or concerns about nat gas prices down anytime soon? I'm not hearing anything. It's above the 200-day moving average. You got to eat through all these people here between 8 and 12 that have bought the stock in the past. But every day that the natural gas supplies are questioned, it probably works.
Yeah, I mean, you know what else? Why don't you pull up VG? I was just talking about this Venture Global, which was
Yeah.
a bad IPO out of Goldman, which is US LNG. And one of the things I would argue to people is that there is a geopolitical statecraft thing going on here where we are, have a bunch of LNG trains coming online, and this is the U.S. wants to have people signing U.S. LNG contracts, not Qatari LNG. And if you saw last night, Qatar's main energy LNG plant got hit, and they're 20% of the supply. Well, it's bad for the people who are, relying on that. But you know what? Bring it in, boys. So this Venture Global, you guys want to stock this ripping and tearing? Look at that one right there. So yeah, I think next decade Venture Global are just signs that if you were wondering if there was a strategy here, I think these are clearly signs in support of that. So yeah, we'll take some pain, but we won't take the pain that other countries will, is kind of the way I think about this.
Yep.
Yeah. I mean,
in healthcare, by the way, there's a couple funny notes. So on street accounts, they sent around that Bernstein launched on Novo, and they actually gave it two mentions: launched at an underperform and launched at a market perform. And so I don't know which one it launched as, but it's I thought maybe analysts have a new way of working both sides so that they can be right either way. My guess is it's an underperform. The stock's down a bit, and people are thinking, okay, this is the loser of the GLP-1s. I will say that the oral medication that they launched is doing exceptionally well. And so this will be a great buy at some point. It might be today. I'm still in the, hey, it's a little bit of a falling knife. Let it stabilize a bit. It looks like it's kind of stabilizing, but so this is going to turn out to be a good one if they can kind of just stabilize and figure out what they're doing in this kind of confusing market. But the race to the bottom continues, and so to make it worse, someone launches with an underperform. Lilly has some good news on their triple combination drug today in diabetes, and so another little bit of distance gets between Lilly and Novo.
Well, let me ask you about that, because the stock didn't care yesterday and doesn't care today on the news. So what's going to make Lilly go up if that kind of data doesn't change sentiment? Yeah,
I think what you're seeing with Lilly is that it just came too far too fast, and this race to the bottom. I think they just have to put up huge numbers now, because it's not super cheap. And they've done a ton of business development that I would bet that most analysts haven't figured out what they're buying. I don't even know the company knows, but I say that tongue in cheek. Obviously, they're a great company. They know what they're doing. But it's like a lottery winner. You ask them, well, what did you buy a year in? And they bought like 14 trucks, and they always wanted a vacation house, so they bought one. And they're just like a hodgepodge of things. From an outsider's view, it looks like Lilly's falling into that trap, that things are going so well, let's buy a bunch of things. Most of these are development stage, which will cost them money later on. So they're either very confident in the cash flow going forward and the earnings projections that, hey, we can make this, or they're setting themselves up for a disappointment. I think the only way that this stock works now is if they beat and raise by a lot.
Yeah, that's a tough chart also. You pretty much need it to hang on that right there, don't you, Kevin? Right? You pretty much need this thing to hold right here, otherwise,
Well, and this is we're seeing this all over the place. The teasing of the 200-day moving average, and the strongest of stocks with the best of stories, are doing this and taunting the market, if you will. And then the ones that are questionable, they've already sliced through the 200-day C financials. And I think Lilly is a little bit like NVIDIA and Palantir. They can blow apart numbers on every line of the income statement, and the market won't reward them. And I think that's where we are.
Yeah, so not cheap companies aren't holding up. I mean, that's pretty straightforward, right? I mean, when the overall market's going down, what are you going to sell? Are you going to sell the high flying, high multiple names? Or are you going to kind of, now they're selling everything, but this one's where I think people are kind of asking, well, what's next? So I will say one other thing on a small cap name, Ovid, OVID. Kevin will remember this one because I brought it up as a penny stock of like, you know what? I think it's a good play if you have a lot of risk. Well, yesterday they did a big financing with a lot of warrants. So if you're an institutional investor, you lucked out. The folks involved though that are mentioned in the press release, so there are countless others who aren't in the press release, but you have Balyasny and Adage, two really smart firms in healthcare. Obviously, Balyasny is a hedge fund, so they can be a lot of different ways. But to be in the press release shows that they're interested. I think that I'm sticking with it. It's up, I don't know, 400% since I mentioned it on Wall Street Beats, or since I bought it, which is when. But you know, with cash now it's more about execution. So I wouldn't make the big prediction that this is the next Lilly, but I'm there and I'm playing along with a small position.
Have you sold any?
I'm sure I did. I'm sure I have. Not. I mean, I'm still at the same dollar amount. I'm at a higher dollar amount than a while ago. So I'm sure I have. This
is the nicest looking chart on the daily level that I've seen in a month. That's gorgeous.
Well, it's easy to have gorgeous things on $2 stocks, right? It's hard to make a lot of money on $2 stocks unless that's your business. So, and that's not mine. I tend to own bigger cap names, but this has been a fun one.
But 60 cents to 232 is pretty damn good. So good for you. Can I throw some at you?
Sure.
And we have been circling the wagons on this. This is Kodak, which I thought was dead, and it's not so dead. This is a nice looking chart, and it's a nice looking chart in a lousy tape. Been up every day over the last 4 days on above average volume. They apparently converted their pension around, took a $400 million of debt down, lowered their interest expense by $40 million. They have a division, print is down 3%, which, that's 75% of the business. 25% of the business is AMC, which is chemicals and medical business that's growing 25%. And, it looks like something's going on here. Apparently there's some dilution that can happen at $10 plus, but this is a turnaround that looks promising. Full disclosure, I can't own individual names, and this isn't going to show up in any ETF where it's going to matter. But I just keep looking at this thing and saying something's going on here. And for those who can participate, I would sharpen the pencils, because Kodak isn't dead, and I thought it was.
They came out yesterday or the day before saying that they're rolling out more print film options. And I was like, really? For whom? But I guess there's someone out there still with some film cameras.
Yeah.
Well, I don't have anything else in healthcare. I mean, obviously there's a lot of news going on, but there's not biotech's actually not getting as hurt as I thought it would. Healthcare has been underperforming the S&P this last week. It was down 2%, while the S&P was down like 1.6, and that's kind of continued a little bit this the first half of this week. I don't think it's a massive underperformance though, so I don't think there's anything that's taking away from the idea of healthcare. Still looks pretty good.
All right. Well, I think let's wrap it there. It was a good little show. We got David back in the mix, so that's good. I am Benjamin Bride. That is Kevin Bakes-Baker, David Maris. This is Wall Street Beats, coming at you every morning at 9 or 10 a.m. Eastern, and we will be back tomorrow. Enjoy the adult swim out there, guys. It's a little choppy.
Thanks, guys. Thank you, Justin.